We are all spending a lot on streaming these days, and Netflix is considering pricing its upcoming ad-supported tier at between $7 and $9 a month. This is according to a new report out from Bloomberg. Now, the company's reportedly on track to launch this service, which would be about half the cost of Netflix's most popular ad-free plan, in the final quarter of the year in a handful of markets, with a full rollout next year. Now, Netflix won't comment on the report, but tells us, quote, "We are still in the early days of deciding how to launch a lower-priced ad-supported tier, and no decisions have been made, so this is all speculation at this point." Guggenheim Partners Michael Morris, he tells us that this price point would be above what they had initially modeled. They are estimating that Netflix will get $3.72 in monthly ad revenue per domestic member in 2023, which could grow to about $10 in 2026. That would give a boost to the bottom line above the current most popular tier, whose retail price is $15.49 per month. The question, though, is how many new subscribers Netflix could draw at this lower cost price, with those ads, of course, sold by Microsoft, and how many current subscribers could downgrade to the lower tier. Now, consumers will be comparing Netflix's new offering to HBO Max's ad-supported version. That costs $10 a month. Plus, Disney Plus, its ad-supported version, is launching at $8 a month in December. Peacock has a free version plus a $5 option with limited ads. Paramount Plus and Discovery Plus, their ad options are both $5 a month. So the other question to watch, though, is the ad experience for consumers. Netflix is reportedly looking at about 4 minutes of ads per hour. That's in line with Disney Plus. Discovery Plus and Peacock, they promise to show not more than 5 minutes per hour. So, guys, it's going to be interesting to watch. And I just have to flag, today is the 25th anniversary of the founding of Netflix.
Wow. Oh, wow. Okay. Quarter century. That's impressive. How much does this really matter, though, Julia? Because for a long time, Netflix was pointing to international as being the real growth engine. And even if you grow a bit domestically by offering a cheaper service that's ad-supported, is there really growth there when you're already selling the international version for less and ads don't yield you as much in a lot of those markets?
Well, I wouldn't underestimate how important this domestic service is, John, because, look, not only do they want to grow the number of subscribers they have here, but remember that Netflix is facing more competition domestically and in the more crowded markets, such as Europe, Canada, some of these other more crowded markets. They're facing more competition than ever. So it's not just about growing the number of subscribers. It's about holding on to subscribers when people are trying to cut back on the number of services they pay for. As Deirdre just mentioned, if people want to spend less, you want to make sure that they don't ditch Netflix and go over to Disney Plus. You want to make sure that they have another lower cost option. So a lot of this, I think, is really about maintaining those subscribers and perhaps generating more revenue from subscribers who are actually paying less. Yeah.